Hi, I'm Russ Brown, and I'm passionate about helping people live better, and I want to save you money so that you can. I want to walk you through an example of refinancing without going back to 30 years. To fully get this, you have to understand interest and understand how a mortgage really works, particularly the components that make up a mortgage payment. So let's break one down. A mortgage payment typically has 4 components: principal, interest, property tax, and homeowner's insurance. Taxes and insurance, they're neutral, like Switzerland. I mean, you're going to pay taxes and insurance in the exact same amounts, whether you have a mortgage or not. Principal is good. Anything you pay towards principal pays the loan down. These are the good guys. Interest is lousy. These are the bad guys. This is the one that you want to get rid of if you can. When you're thinking about refinancing, get your eye focused on that interest. It's like toxic acid in the system. Now, stick with me through an example. Let's suppose 3 years ago, you got a $250,000 mortgage at 4.75%. And we call and say, hey, we can drop you to 4% and the lender will pay for your closing costs. Now, before we go further, let's break down your current payment and balance. Back when you started, here's how your payment was calculated. Your taxes and insurance are just given. Let's say $180 for taxes and $60 for insurance. The interest you can always figure out. And this is important. The amount of interest you pay is always equal to the current loan amount times the interest rate divided by 12 for months. So for the first payment, that's $250,000 times 0.0475. That's $11,875. And that's how much interest you'd pay for a year, but we want monthly, so we'll divide by 12 and get $990. All that's left to figure out is the principal, and I need a financial calculator for that. It says that the principal and interest payment is $1,304. So the principal portion of this payment you can figure is $1,304 minus $990 of interest, which equals principal of $314. Whew, finally, got all 4. All totaled up, it's $1,544. So you're rolling along right now paying $1,544 per month, and you've done that for 3 years. That's 36 payments. And your balance has gone down, but let me show you exactly how. After your very first payment, you know that of the $1,544, only $314 went to principal. The rest paid taxes, insurance, and interest, and got vaporized. But the good guys, the $314, it paid your balance down from $250,000 to $249,686. So the next month we recalculate the interest, and like I said, it's always the current balance times the interest rate divided by 12. So the new interest is the balance of $249,686 times 0.0475 divided by 12, which equals $988. We know the P&I payment is consistent at $1,304. So subtract the interest and you have the new principal payment of $316. Hey, your principal contribution went up by $2. In truth, without rounding, it's just $1.24. And your interest expense went down by the same amount. Congratulations. Early on in a mortgage, most of the payment is interest. That's why people complain that mortgages are front-loaded. But that's just because you borrowed so much money. It's not a conspiracy. It's just the interest on what you borrowed. Next month, your new principal balance will have gone down to $249,370, and this little cycle repeats itself every month. By the end of 36 months, you've gone from $250,000 down to $238,217. Good job. And here at this point, I call you and say, hey, you should refinance down to 4%. Okay, so let's suppose we do it. And we have the lender pay the closing costs and are able to issue a new loan for just what you owe, $238,217, but now at 4%. You have 3 options that are going to come into play. And I'm going to set aside taxes and insurance because they're neutral, like Switzerland. 1, you could go back to 30 years. And if you do, you'll enjoy a new lower P&I payment of $1,138. That's $166 a month less than before. Or 2, you could keep the exact same term as you have now. That's 27 years left. And I can tell you that the P&I payment you'd have to make in order to do that would be $1,204. That's still $100 less than you're paying now. Or 3, you could keep paying the same amount you're paying now, $1,304. And what would happen is your loan would pay off in 283 months. That's 23.6 years. That's 3.4 years sooner. That's roughly $53,468 in savings to you, and you're still making the exact same payment as before. So you don't have to go back to 30 years. It's all up to you. $53,000? Yep. Save it in your sleep. We'll show you how. That's just one of the things that smart mortgage buyers do.